stocks collectively for the largest U.S. banks were up about 18%. So we're talking about a higher bar to meet for a lot of the banks, and you've seen them fail to meet that higher bar, even though the results on their own were fine and solid. Wells Fargo's best Citi really is proving to make really good tangible progress in terms of returns and profitability. And Bank of America, the focus on the earnings call, the analysts were really touching on expenses for the first quarter. So those were sort of the pressure points for today's bank earnings.
Herman, we also saw Citi's CFO Mark Mason today push back against President Trump's proposed cap on credit card fees. Mm-hmm. What did he say about the impact of that potential policy?
Yeah, I think those comments really echo what the industry has been saying so far. The CFO for Wells Fargo also came out and talked about it. Bank of America talked about it. It really is counterproductive, right? So I understand President Trump's point of, improving profitability, but really, if you do place a cap on credit card rates, it will turn off the credit availability for a wide swath of consumers in the United States. So that's really the trade-off here. And I think the market's really saying it's not a healthy thing to do for the broader economy. And the bank CEOs and executives are echoing that.
Yeah, it's kind of notable that the bank executives are pushing back so vocally against President Trump, something that they haven't done a whole lot. But when it comes to their credit card business and what they see as kind of the overall ramifications, they're very quick to point out the drawbacks here.
Yeah, it's a bit of a bridge too far, right? So we're talking about making the card business virtually unprofitable for a year. And who knows if that cap really is going to be lifted, even though the president's saying only a year in duration. So I think it really would hurt the entire system. Just to give a data point, for the stress test, we're talking about stress losses in credit cards of 17%. And if banks can only generate 10% interest on it, it makes it an uneven risk reward for the banks. So that's what we're talking about here.
Herman, we also saw Citi's M&A fee haul surge 84%, a record deal-making year for them. Do you expect that robust deal-making activity to continue to be a boon for the banks this year?
Yeah, that's right. So there's a lot of optimism for investment banking heading into 2026, not only for Citi, but for the group. We're talking about a really robust IPO calendar. M&A is something that is really ratcheting up, given we talked about the negatives for Trump policy, but the deregulation is a positive for the banks in terms of increasing M&A activity. The private equity folks are coming in and being more active. And lower interest rates helps with borrowing costs with respect to M&A. So that's all positive, and we expect a further improvement across investment banking and underwriting and M&A going forward.
Right, which bodes well for Goldman Sachs and Morgan Stanley earnings tomorrow because they're so much more exposed to that side of the business. However, it strikes a contrast to what we heard from JP Morgan yesterday with that unexpected drop in investment banking fees. What does that tell us about what happened at JPM or what might not have happened at JPM last quarter?
Yeah, that's right. So they had guided to a bit better investment banking performance, but there was a slight decline in the fourth quarter. The management talked about it being more of a delay in activity in the fourth quarter. Some of the deals that they were expecting to hit in the fourth quarter got pushed out into the first quarter. So no real disappearance in those actual fees, but just a delay in actual realization.
Were there any metrics that stood out to you from any of the reporters today that were very notable? Anything different from prior quarters from any of the banks?
Yeah, I would say on the expense front, JP Morgan had talked about yesterday a 9% growth in their expenses. Bank of America came out and talked about expenses, at least in the first quarter, to be up about 4%, which surprised the analyst community. So that's what's really pressuring the stock today. In contrast, Wells Fargo is talking about 2% expense growth for the year. So looking better on that front as they really improve their efficiencies and the like. So a mixed trends there, but expenses are top of mind.
And a lot of excitement about Citi, especially with Jane Fraser, the CEO and now new chair of the firm, the turnaround plan she's put into place. It really feels like things are starting to pay off. You know, it's a slow moving transition, but it's happening.
Right. It is a multi-year endeavor to improve that behemoth. So they've done a really credible job of simplifying the company, reducing their exposure internationally from a consumer perspective, and improving returns. And that was tangible in the fourth quarter. Their efficiency ratio, or cost of revenues for industry parlance, improved about 130 basis points year over year. So that really shows that there's momentum in the business, cutting costs, improving the top line to really drive that return on tangible equity target that they're talking about for 2026 of 10 to 11%.